This is your Wall Street wake-up call. Stocks may be flirting with record highs, but this market is still being driven by oil. I'm joined now by David Nelson, the chief strategist at Bell Point Asset Management. So David, oil had a great week, up about $4 to $48 a barrel. Why are investors so obsessed with oil still?
Look, oil's been in and out of a bear market so many times over the last couple of years. Oil is still the key, and it doesn't have to go meaningfully higher, but what it can't do, we can't support a bull market in stocks or anything without oil at least stabilizing. So as long as we're above that $40 mark, that seems to be where the market seems to like it, we're okay. We drift below that, you got some real problems, especially in the financials.
Well, and you say one way to play oil is through the banks.
Yeah, actually, it's an interesting dynamic right now. If you think back to February and March when oil was cratering, one of our biggest concerns was the loans to the energy complex. And Jamie Dimon and Brian Moynihan of JP Morgan and Bank of America, they talked about this, how concerned they were. As oil goes up, and if it can sustain these levels, at some point in time, these banks are going to have to release the reserves they took.
And what does that mean?
Well, they took reserves on bad debt, in anticipation of bad debt rolling over and possibly defaulting. If that debt doesn't default, eventually they'll release those reserves, and that will add to the bottom line quite significantly.
All right, moving on to the rest of the markets. I mean, over the past 9 days, we saw 2 days where all 3 major stock indexes closed at a record high. What does that tell you?
Yeah, but we didn't go meaningfully higher. It wasn't like we really burst out to the upside. We've already had our big move. I think we're marking time. We're waiting for an event, and like everybody else, we're trying to figure out what that next event is.
Well, and that next event could be a September rate hike from the Fed. Of course, we got some pretty dovish minutes this week.
Yeah, I've been so wrong on the Fed for the last couple of years. I'm probably the last guy you want to talk to. I think they very definitely want to raise, and it's not because the economy is really roaring. We're probably hovering close to stall speed right now, but they want to give themselves a buffer zone. Right now, they want to have some kind of room so that if they have to accommodate at some point in the future, they got some room to do it. Right now, they've got nothing.
Well, and do you think the Fed is trying to sort of slow this stock market rally that's been happening? Because many investors think the rally was built on the Fed.
Well, to a large degree, that's true. I mean, equity valuations are pretty full in a vacuum, but when you look through the prism of interest rates, you can really speak to a higher market. I don't think they're trying to talk the market down or slow it down, but I think they have their own dynamic. They want to keep the market and players off guard. They do a very good job of that because no matter what they do, you can expect a parade of Fed governors to come out in the successive days after that, really talking the other side of the book.
All right, and then just sort of going forward, your strategy, as we head into the fall?
I try to think on themes. I look at individual securities right now. It's hard for me to make a real strong case for the S&P. For individual stocks and sectors, I'm still a player in defense. One of my names got hit really hard this week, Lockheed Martin, through a spinoff of part of one of their divisions. Investors didn't like that so much, but I'm still invested there pretty heavily. I still like technology. There's still some great plays there.
All right, David Nelson, thanks for coming by. We look forward to having you back soon.
Thanks for having me.
I'm Scott Gamm, and you're watching The Street.